the order, we're going to start with Randall Henning. Randy has been a visiting fellow and a senior fellow at the Peterson Institute for International Economics for longer than I can remember. He also teaches at an American university, and he is probably the U.S.'s leading expert on Asian monetary integration, having written the definitive study on the Chiang Mai Agreement. And so he has also done a lot of work on European issues in the past, as many of you know, so he's uniquely positioned to give us the view on how East Asia is looking at the euro as a reserve currency. Randy.
Thank you very much, Adam. I'm happy to participate in this celebration of the 10th anniversary of the creation of the euro. And I compliment Adam and Jean for organizing such an interesting program today. I've done a little work recently on Asia, as Adam said, but I also consider myself an early and consistent supporter of the monetary union in Europe. As you'll hear in my remarks, I'm not particularly bullish on prospects for the euro as an international currency in East Asia, but I don't think that having a global role is the most important test for the success or failure of a currency or its monetary union, nor would a global role for the euro necessarily benefit Europe. An international role carries costs as well as benefits, and examining the role of the euro as we do today is important for other reasons, such as for the operation and stability of the international monetary system. Now, my remarks fall under four headings. I'll spend roughly 3 minutes on each. First, the overall prospects for the euro, the approaches to understanding currency use in East Asia, alternative approaches, the recent empirical record, and the relevance of Asian regionalism, and then I'll briefly conclude. Most of my presentation is verbal, though I will have a couple of visuals on the relative status of currencies in the region. A hard copy of the slides is available at the back and outside afterwards, so you don't have to take notes furiously as I go probably way too fast through the slides in the presentation. Now, on the overall prospects for the international role of the euro, the advent of EMU created an alternative to the dollar that is potentially more attractive than any of the legacy currencies or of the yen. When asked about this, Larry Summers at the Treasury Department in the mid-1990s was fond of saying, the fate of the dollar is still largely in our own hands. And this was reassuring, but in a diplomatically evasive kind of way. In recent decades, the United States could make macroeconomic policy mistakes, such as monetary policy in the 1970s and fiscal policy in the 1980s, with relative impunity because the currency alternatives were limited. And I argue that the United States would pay a greater cost in terms of diversification out of dollar assets if it made such mistakes after the creation of the euro. Until recently, at least, though, the U.S. has been relatively well behaved, and the euro's encroachment on the international role of the dollar has so far been on the margin rather than game-changing, I'd say. The euro has become widely used in its own regional neighborhood, but not as a global currency seriously challenging the dollar in other regions. And this is my reading of the ECB's reports on this subject, which Linda had mentioned in the earlier panel. This is where Asia comes in. 7 Asian countries, including India for the moment, rank among the top 10 holders of official foreign exchange reserves. And 9 Asian countries rank among the top 15. The reserves of ASEAN plus 3, adding Hong Kong and Taiwan, amount to almost $4 trillion, more than 54% of world reserves. And of course, East Asia represents about 20% of world product, 25% at purchasing power parity, and 27% of world exports, and these percentages are growing. So if the euro were to break out of the European neighborhood into a global role, it will have to capture currency market share in East Asia. The question is Asia at a tipping point? Now, Ron McKinnon's, when I think of this question, I situate the analysis between the alternative views and work in the literature. And Ron McKinnon's East Asian dollar standard comes readily to mind. In his view, conflicted virtue generated soft, informal pegging to the dollar by countries in the region, and given his assumptions and orientation, such reliance on the dollar is both desirable and likely to continue. His approach is closely related to the revived Bretton Woods interpretation offered by Dooley Garber and Folkerts-Landau, who defend Asian intervention, currency undervaluation, and accumulation of large piles of dollar reserves. Counterpoised to the revised Bretton Woods view are many who believe this pattern of intervention and reserve accumulation to be unsustainable. Barry Eichengreen has written about this from the systemic perspective. Faced with continued U.S. current account deficits, trend of depreciation of the dollar, and an intractable collective action dilemma among reserve holders, Asian central banks will at some point dump dollars for other currencies. And that point would be the euro's historic moment of opportunity. Though their argument is not Asia-specific, Jeff Frankel and Menzie Chin are particularly bullish on the euro. One of the things that I like about their recent article is the emphasis on the concept of the tipping point in the use of reserves. Frankel and Chin believe that such a tipping point could come as early as 2015. Now, what is kind of the actual role of the dollar and euro in East Asia? Overall, of course, the dollar continues to play the dominant role. If it has experienced a decline, that has been on the margin. With respect to shares and foreign exchange reserves, we know that at the global level, the dollar share is about 62.5% in value terms and 68% in quantity terms. And within East Asia, of course, most currencies don't disclose the currency composition reserves publicly, and we have to be content with authors' estimates. In this next slide, it compiles kind of these estimates made in various places in the literature. And although the country coverage is incomplete, the largest reserve holders are represented. And some of these guesses are fairly well educated, and the numbers for Australia and New Zealand are known rather than estimated. Given large holdings of the Northeast three, China, Korea, and Japan, we can guess at the currency composition of reserves for ASEAN plus 3 as a whole, and my guess is a dollar share of about 74%, plus or minus 5%. So it appears that the role of the dollar is greater in East Asia than in world reserve holdings, and given that we would expect the yen to play its small remaining role in its own regional neighborhood rather than outside, the share of the euro must be correspondingly smaller. There is a caveat. The shift of reserves into sovereign wealth funds could mask currency diversification. Monetary authorities who diversify might well initiate that shift through the most opaque vehicle, especially if they were concerned about beating other dollar holders out the door along the lines of Eichengreen's collective action dilemma. That the currency composition of foreign exchange reserves is disclosed collectively, but that of sovereign wealth funds is not, kind of argues in favor of using the latter as the vehicle. Now, the dollar also dominates as the reference currency for hard pegging, soft pegging, and managed floating within the region. The next slide shows the exchange rate regimes of East Asia as classified by both the IMF and by Reinhardt, Ilzetsky, and Rogoff. The table shows the degree to which rates are still pegged and managed in the region. But of course, the composition of the baskets against which they're managed is also generally opaque, spawning a cottage industry devoted to estimating them. Frankel and Way and McKinnon and Schnabel, among others, have estimated the implicit weight of the dollar to be very high, above 90% in the case of China, The Malaysian ringgit shadows the renminbi very closely. Hong Kong, of course, has a currency board based on the dollar. The Korean won, Singapore dollar, and Thai baht appear to give somewhat less weight to the dollar and a modest weight to the yen. Little, if any weight, is given to the euro in these implicit baskets. And the ECB lists no East Asian country among those using the euro in baskets for pegs and managed floats. The general picture of dollar dominance and minimal euro encroachment is reflected in the other international roles for currencies, which I'll skip through pretty quickly. As a vehicle currency, the dollar dominates foreign exchange markets in East Asia as it does globally, being on one side of about 90% of all trades. The euro is on about 18% of all trades, about half that for the yen. The euro has a modest share, 24%, in international debt securities in East Asia, less than it does globally. The euro plays a small role in trade invoicing. I apologize again for skipping through these so quickly, but my clock is running. And these shares are smaller than Europe's shares in world GDP, trade, and capital markets, which I just list here briefly for comparison. These shares are not particularly out of line with Europe's share in East Asia's exports, which is 12% for the euro area and 15% for the European Union as a whole. On the far right-hand side of this chart, the euro area and EU lines are the two lowest. The dollar's share exceeds the U.S. share in the region's exports, which is about 17%, down from 32% 20 years ago. That's the green line. The striking part of this chart is the reversal of the relative status of Japan and China. Japan being the broken, on the far left-hand side, the broken blue line at the top, then at the bottom on the far right, China being the red line, showing the greatest increase. Now this brings me to Asian regionalism. The sustained use of the dollar stands in marked contrast to the discourse within East Asia on regionalism and the need for self-help mechanisms to reduce reliance on the IMF and, by extension, the United States. But consider the role of the dollar and the absence of the euro in various regional projects. There are, at last count, 17 bilateral swap agreements in the Chiang Mai Initiative, totaling a little less than $60 billion if you eliminate double counting. 13 of these swaps are of local currency for U.S. dollars. 4 of these swaps are between local currencies. Besides the dollar, no non-Asian currency is involved. Several bond market initiatives have been launched with the intention of capturing the intermediation that is being done in London and New York and of creating a pan-Asian bond market. The accomplishments are patchy, but if more successful in the future, they seem to be more likely to foster currencies within the region than the euro. Former Prime Minister Thai Prime Minister Takshin's proposal in the Financial Times earlier this week to create an Asian bond, while obscure on some crucial details, appears to be a case in point. And the same can be said for the small regional bond funds that have been created. East Asian governments are now discussing transforming the Chiang Mai Initiative from a network of bilateral swaps into a collectively managed pool of reserves. Let's call it, until they decide on a different name, let's call it an Asian Monetary Fund. If they create it, East Asian governments will face the decision not only of how many reserves to place under collective management, but also what currencies. And my initial guess is they'll decide to pool only dollar reserves. And then, of course, there are proposals for common currencies in East Asia, or a subgroup within the region. Among the more thoughtful is Peter Kennan and Ellen Mead's analysis of a common currency for ASEAN. All this is to suggest not that various regional projects will necessarily come to fruition anytime soon, but that when Asians consider reducing dependence on the United States and the dollar, their first preference is to consider alternatives within the region rather than other outside currencies, such as the euro. The expectation that Europe will decline as a share of world GDP in coming decades, followed a little more gradually by the United States, will reinforce the temptation to bypass the euro in any long-run shift from the dollar. Of course, the problem faced in Asia is that the yen has diminishing attractiveness and the renminbi is not yet suitable for a host of reasons. So, in conclusion, it might be useful to ask, what would it take to give a major boost to the role of the euro in East Asia? And are any of these scenarios plausible? Well, one possibility might be a major financial crisis in the United States, followed by a great recession. But of course, if such a crisis affects Europe equally and the response is more fragmented, that's not likely to help the euro in Asia. Another possibility could be a sustained rise in inflation in the United States, undermining the dollar's role as a nominal anchor and as a reliable store of private value, private wealth. A third possibility could be a sustained revival of the European economy and increase in its potential growth rate. But I think that the most plausible of these rosy scenarios for the euro, in my view, rests on low savings rate in the United States, continued current account deficits, accumulation of external debt, and a trend of depreciation of the dollar. And if unchecked, I think this entrenched pattern probably will reach a tipping point, even if that the date and location of that tipping point is hard to determine in advance. Those wishing to increase the euro's role as an international currency will want that point to come soon, rather than after other currencies emerge as second and third alternatives. And I'll leave it at that. Thank you.
Thank you, Randall. Thank you very much, Randy. Following past patterns, what I'm going to do is ask each of our panelists to come up, give their presentation, but then since we do have time, ask them all to come together to take questions and comments at the end. I'd now like to turn to György Szapáry of Central European University. He introduced himself as a banker and central banker earlier today. He actually had a very distinguished career as the chief economist of the Hungarian Central Bank and led that understanding during the transition period. And so we're all very eager to hear his views on how the new member states and Eastern Europe are viewing the rise of the euro vis-a-vis the dollar. Thank you, György.
Thank you, Adam. I would like to thank the Peterson Institute, and particularly Adam, and then Bruegel Institute and Jean and André for giving me the opportunity to talk about at this very interesting conference. Adam, you mentioned that this is not a less interesting subject, perhaps the regional role of the euro because of the crisis. Well, I will point out a few weaknesses in the euroization that actually has increased the vulnerability of these countries. But as we have...
Can everybody hear in back?
Do you everybody hear? Yeah. But we also have a saying in Hungary which says the situation is hopeless, but it can be handled and solved. The rising role of the euro can be assessed by a number of things. The pegging relationships, the currency composition of foreign reserves, the composition of foreign debt, the use of euro in bank lending and deposits, the euro's share in settling and invoicing foreign trade, the use of euro in domestic markets, or contracts, euro banknote purchases from and sales to countries outside the euro area, but within the region, and indirectly by the convergence of inflation and interest rates to the euro area levels. I will skip a lot of charts, and I will just show this. The first chart shows blue is euro. So More blue means that you either you have some sort of pegged relationship to the euro. And if it's fully blue, that means that you are either a member of the Eurozone already, or you are Euroization, like Montenegro, Euroization. And you can see that it has increased. Countries like Lithuania that had the currency board pegged to the US dollar has become pegged to the euro, is also has become a member of the ERM2. So basically what you see is that in the region it got more blue, basically. Now, there are a number of countries that are floating. So let's see what happened to those countries that have been floating. And this is the minimum variance basket, percentage share of the euro. And as you can see, even the floaters increasingly follow the euro. You see to the left side, Czech Republic, Hungary, Poland, Slovenia, and Slovakia, and on the right side, the Balkans, which are not members of the European Union, Croatia, Albania, Serbia. Only Moldova is the US dollar. The rest started to move toward the euro. And what is even more interesting, if you look at the panel below, that you have Russia in there, another dwarf, perhaps, that is moving toward the more in the euro. Actually, Russia has a basket in which you have 25% of the euro. So this pegging relationship in the region to the euro has increased. This chart, I did this just for control. And interesting things, you see two other dwarfs, Australia and New Zealand, that are increasingly following the euro. And even a third drop, Canada, the green one, is also doing it. I don't have a precise explanation, except for Australia and New Zealand, which they have said. Australia has explicitly said that they are looking at the euro in a more active way. But I have no explanation for Canada, not yet. I will try to find out. But basically what it shows, that at least the minimum variance basket shows that the euro, in the pegging relationship or in the following the exchange rate, is playing a bigger role. This might change, of course, because those are very far from the euro area, but it's an interesting observation. Now, here just very quickly I want to say one point I want to make here, that the exchange rates against the euro over the years has either appreciated or depreciated. You can see that in those countries. But one thing that is common to all these countries, because these are catching up economies, that the real exchange rate on a CPI basis have appreciated vis-à-vis the euro, and this is part of the equilibrium phenomenon of a catching up economy, that you have a real appreciation of the exchange rate, and this can be done either by a nominal appreciation or by higher inflation if you have a fixed exchange rate, or a combination of the two. But this will have some implications later on. This is the reason why I have shown you that. Now, currency composition of reserve. It's difficult to get the currency composition of reserves because this is, in most countries, this is a confidential data. However, the IMF has published data, but lumped the countries together, and it has a chart here, which is euro area neighboring regions, and that has, of course, has all the new members and some of the members in the region that are in there. And it shows that the euro has the largest share in it, 50 to 60%. And there are a few countries that publish data that I have put here in the chart. Those who publish, Bulgaria, Croatia, Latvia, Lithuania, Romania, and Slovakia, you can see that the euro has a large share in the reserves. That was the second benchmark to see the role of the euro. Now, another one is the currency composition of external debt. Again, you cannot get it for all countries, but those which publish this type of data, you can see that it is very high and it has been increasing. Even in Bosnia, it has increased from 80% the first line. But in all countries it has increased, and it's very large indeed. The share of euro in bank deposits and loans. Now here, I would like to stop for a while. As you can see, the euro share of foreign, let's start with the foreign loans to the right, because this is a more interesting part of it. The euro share in foreign loans as a share of total loans, which is the lighter blue. You can see it's very, very high. In some countries, obviously Montenegro, obviously it's 100% because it has only euros. But say Estonia, Latvia, Lithuania, of course they have currency boards, but still, you look at Hungary, Romania, Albania, 50, 60%. The reason for that is basically that people wanted to borrow at much lower interest rates, and the euro interest rates are much lower. And that has really created a problem, not only in the way of a mismatch that, you know, the borrowers, which are basically households, but also corporations, but let's talk about households a moment. Many of the households have borrowed in euro. In Hungary in particular, it's Swiss francs, but it's still, the issue is the same. They have taken on a large exchange rate risk. But what they have seen is that the interest rate is low, lower than in most cases in the foreign currency, and the exchange rate has been appreciating in many of these countries in nominal terms because of the euro euphoria, having joined the euro, the European Union, or expectation of joining the euro area. So inflation was high, you really faced very negative interest rates. So that has tremendously encouraged borrowing, and a very rapid increase in the borrowing of households, both for mortgages and for consumption loans. And that obviously, in times of crisis, creates a problem. And this is what I wanted to say, that there is a heightened risk now in these countries because of the large obligations in foreign exchange. Now, some of the countries did experience a housing boom, and those were typically the Baltic states. There was housing price booms, and also in Romania to some extent, but less in the other countries. So somewhat the issue is mitigated compared to what you have here in the United States, but the foreign exchange exposure is very large. This is just a table that shows that separately for households and corporations. I passed this one. Okay, one thing that I wanted to show here, that in countries with fixed exchange rates, the regimes lead to higher foreign exchange borrowings. Why? Because the exchange rate risk is much less. So what you have here is, I showed it the Baltic countries that had fixed exchange rate, currency boards, and you could say the foreign currency borrowing in these countries is particularly large, larger than in the other countries. Bulgaria is still very low, even though it has a currency board, but it's increasing very fast as well. And fixed exchange rate, because on the one hand you had less of an exchange rate risk, on the other hand this catching up, what could call equilibrium catching up of the price level was done by higher inflation. The real interest rates were particularly negative in those countries, or very, very low if you take into account the charges that the banks charge and so forth, or very, very low. So it even encouraged further the foreign exchange borrowing, and you could see the adjustment that's going on in the Baltic countries, having gone from an increase in the GDP from 7-8%, now Estonia is zero, negative growth, and in all the countries the growth has declined. It just shows the dangers of overshooting and overheating that this has created. Now, this euro share in settling invoicing and foreign trade, you can see it's very, very large, and also you can see it's larger than than actually the share of exports or imports. Now, Linda Goldberg has a very interesting paper of 2005 where she actually argues that some of these countries have maybe overdone the invoicing and settling in euro, and maybe this is not optimal. However, if you see, that was a paper Linda wrote in 2005. However, if you see the pegging relationship that has actually increased in the region, you can find a reason for this. I mean, an exporter or an importer that sort of pegs or follows the euro has an advantage of invoicing in his own interest, because he is invoicing in a currency that is fluctuating less volatile vis-à-vis his own domestic currency. And I think this has certainly encouraged invoicing in euro. How many more? 2 minutes, okay? The euro is used in domestic contracts and transactions a lot. There are no data for that, but by my experience in Hungary taught me that many of the contracts, particularly leasing contracts of offices, but sometimes also of residential housing, are contracted in euros. So that also, I don't talk about the flow of currency. Well, convergence of inflation and interest rates, obviously that's a normal thing, that if you peg or follow a currency and then you want to actually at the end enter the monetary union, that you will see the inflation and interest rates converge in that period. I don't want to talk too much about this, but in conclusion I wanted to say one thing. How the present crisis has impacted the prospect of the EU members which are not yet members of the Eurozone to enter the Eurozone. Up to now, the major hurdle was inflation, because over the government deficit you have reasonable control. It's a decision of the government. You have reasonable control. However, over the inflation you have less of a control, particularly when you had fixed exchange rate like the Baltic countries. The Baltic countries wanted to enter as soon as possible the Eurozone. They entered the ERM2, but then they found out that their economy was overheating and they could not meet the inflation mastery criteria. However, now with this new crisis, I think the fiscal situation is going to be very different. First of all, because, as we know, whatever bailing out there might be, or help in the banks, or recapitalization, whatever it can come in these countries, it will have a fiscal impact. But more importantly, perhaps, we are looking toward a credit crunch in these economies, because as I showed you, a large part of the borrowing is in euros. Banks collect in this country domestic currency. So the banks relied either on their mother banks or just borrowing directly by issuing bonds from the euro. Now this is, for the time being, this channel is practically closed, which means that there will have been much less resources to lend, and what they can lend will be at a much higher interest rate. So there is going to be, I believe, a credit crunch. It's going to have a big impact on the rate of growth for next year at least in these countries, which will be bound to affect the fiscal situation. So that will make it, I think, in the mind of many countries that thought that they wanted to join rather earlier than later, there is a risk that this event will be postponed. Thank you for your attention.
Thank you, György. As Fred is fond of reminding us, nothing gets people excited like a forecast. So that was a great note to end on, applying things. We're continuing our tour of the world with Mohsin Khan of the IMF. Mohsin has long been a colleague of ours, particularly our colleagues Morris Goldstein and Mike Musa. He's had a very distinguished career at the fund, is now head of the Middle East Department. Many of you knew him when he was running the Institute and his various other roles. And from his perch, he will give us his unique views on what the Middle East and the oil exporters are thinking in terms of making use of the euro with all their money.
Thank you very much, Adam, and thank you for the organizers for inviting me. The institute that Adam was talking about is the IMF Institute, not this one. Anyway, as Adam said, I'm going to talk to you briefly about the Middle East. Basically, the backdrop, the role of the euro in the Middle East, North Africa region. I'll start off there, and then I will move to where the big action is in the Middle East into the Gulf. Now, the euro has really, at this point, not played a dominant role. It's increasing, but increasing very slowly in the MENA region. And this can be seen with as I will show, in MENA's trade and exchange rate regime and holding of reserve assets. So let's look at trade first. As you can see, dollar transactions dominate MENA exports. And one, of course, destination of MENA exports is 21% is going to Europe. But the fact of the matter is, the reason I'm saying they dominate on the export side is because of oil. Oil is priced in dollars irrespective of where it's going. So that really takes something, about 70% of MENA exports, by the way, are oil or oil related. On the import side, there's been a significant growth in terms of importing from Europe. Most of the trade that's taking place with Asia, in fact, is taking place in dollars. So the fact of the matter is, at the moment, if you think on the trade side, the role of the euro is growing, but not that much. What about reserves and reserve holdings? And this we're doing over the period of time, just to show you the sort of growth that's taking place. With the rise in oil prices, of course, MENA's gross reserves, now I'm talking about reserves here, not holdings in sovereign wealth funds. I can come back to that a bit. Gross reserves have really quadrupled over the last 10 years. I mean, they reached 830 billion in 07 and are expected to cross the trillion mark this year. Now, the currency distribution, this is a continuing problem. Currency distribution is really undisclosed. Countries don't report it, or if they do report it, they report it on a very confidential basis to the IMF. And the IMF has undertaken a commitment that if it ever publishes their data, it's done in aggregate form. So it's never, you can never actually report individual countries. But suffice to say that at the moment, I'll just tell you, the major share is in dollars. When I come to the GCC, I'll be a little more specific there. Because here we're talking about something like 20 countries in this. Exchange rate arrangements. Here's the big difference from the other two presentations that you've seen. Most of MENA countries are pegged to the dollar and continue to be pegged to the dollar. 13 out of the 20 MENA countries have their currencies pegged to the dollar. 4 countries have a peg to a basket. That's Kuwait, which has an undisclosed basket. And here it becomes interesting. Morocco, this is in North Africa, and Morocco, which has a basket which has 80% euro and 20% dollar. And Libya, which is pegged to the SDR, and Syria, which is also pegged to the SDR, the SDR basket. Now, 3 countries in this in the MENA region have a managed float. But that's sort of stretching the definition of managed float a bit. Really, the only country that does have a truly managed float in that sense is Sudan. The other 2 countries are the North Africans again. Algeria and Tunisia claim to be in a managed float, and we take them at their word. But you can very quickly discover that they are, in fact, following a basket. In the case of Algeria, you can work it out very easily. 60% is dollar, but that's because of oil and gas, and 40% euro. And in Tunisia, it's 45% dollar and 55% euro. So apart from North Africa, really, virtually all of MENA is, in fact, either pegged to the dollar or in the case of one, managed floating. So much for MENA. Let me just move on to what we would call the sort of now epicenter of the Middle East, which has shifted away from Egypt and North Africa, well, Egypt and Jordan and Lebanon, etc., to the Gulf countries. And this is the Gulf Cooperation Council, which is made up of 6 countries. There's been an increased interest in recent years, naturally, on the GCC. Record high oil prices, of course, that's one. And these resulted in, of course, as we would expect, massive buildup of reserves, and I'll come to that. Very large current account surpluses, and more recently, higher inflation. Now, the question is, the facts of the matter are, they are all pegged to the dollar. Kuwait changed its peg in May of last year, but it's very interesting. Until very recently, the monetary, the business cycles of the two were out of business cycles. Sorry, of the GCC and the United States were out of sync, where because of inflation, the GCC countries probably needed to tighten because they were in a boom, and on the other hand, the country that they were pegged to needed to loosen and was in fact doing that. And then there's a perennial question that keeps coming up: should they change their exchange rate regime? And so these are the reasons that that the GCC has really attracted a lot of interest. What about direction of GCC trade? Well, as I mentioned earlier, dollar-denominated transactions in the GCC represent even a bigger share than in the whole MENA, and virtually all exports are priced in dollars. So for them, there is, even though they're exporting to Europe, they're actually getting paid in dollars for what they do. And they are not exporting that much to, as you can see from the destination of exports, to Europe, 9%. And, Asia is by far the largest. The US is 9% too. But interestingly enough, about 70% of their imports are priced in dollars as well. With Europe being, 31%, so 69% of it are priced in dollars. They do not, in some countries like Saudi Arabia, people say the ratio is even higher. Well, in fact, it is higher. Now, then we come to their reserves. As you can see, the spectacular rise that has taken place in the period, let's say, in the last three years or so. These don't include the foreign assets held by sovereign wealth funds. So these don't include the so-called $875 billion held by IDEA, a figure I can't vouch for, but it's in the Peterson table, so I use it. What is it? It's actually, to be fair, it's a Morgan Stanley figure that was constructed 2 years ago, and it's still used on the. I assume that they haven't made any more money, so they're still sticking to 875. I think so. I'm excluding all that. We're probably excluding a couple of $1 trillion in the process. But anyway, just take a look at the official reserves. They reached 420 billion in 2007, and they're expected to cross the $500 billion mark by the end of this year. Now, as I said, data are not generally made available to people, but dollar-denominated reserves, the dollar share in these reserves is 80% plus in these reserves. We know that in some countries it's even higher, but the reason is that in Saudi Arabia it's a little over 80%, and Saudi Arabia is a giant in this group, so it brings the thing down. In some countries it's 95% held in dollars. In sovereign wealth funds, which is, as was said, I think earlier, they are very opaque, and it's very difficult to tell where, in fact, what currency they're holding their assets in. If you look at their financial assets, my guess would be that it's sort of similar to reserves, but then on the other hand, they're very long-term holders, and so they could very well be in euros. In FDI, they've been doing a lot of foreign direct investment. In most cases, they're doing it in dollars because when they invest in the region, they invest in and get their returns in dollars. So then we come to exchange rate regimes. And basically, as I said, all of them except Kuwait are pegged to the dollar. And the reason they're pegged to the dollar, they decided in 2003 to peg to the dollar basically to facilitate the transition to a single currency in 2010. And they were pegged to the SDR prior to that, but de facto pegged to the dollar. Well, they have all the reasons that, that was the main reason, but there are all the standard reasons for why you want to peg and why you want to peg to the dollar. There's been talk about revaluation, constant talk about revaluation. I think the pressure is off right now, so I won't go into that. Floating is not really a viable option at this point. I mean, the markets are just not there. The markets haven't been developed. And you have this issue of oil is priced in dollars, so it's just from the importer side, hedging, etc., is much easier if you're pegged, and they're used to that. Pegging to the oil price is a little bit exotic, but everyone, whenever I give this talk, people ask about pegging to the price of oil. I'll skip that. But here, of relevance to the euro. Now, let me come to what is the basket peg idea. And, sorry. Oops. I've gone back. Let's do that. No, sorry. I got it. Coming to the basket peg. And here, to just be very brief, of course, pegging to a basket, which a lot of people have recommended, and does buy you flexibility, but it doesn't buy you monetary independence. And the argument people make is you've got these high reserves, you have current account surpluses, you've got inflation because your real exchange rate has to appreciate because your equilibrium real exchange rate is appreciated, so they're getting inflation. How do you combat that from an exchange rate point of view? Well, move to a basket. But, if you think of moving to a basket, yes, it's sorry, I've done it again. If you move to a basket, it may buy you some flexibility, but it doesn't really buy you too much monetary independence because, I mean, the idea was that, Saudi interest rates should be much higher right now. Monetary policy should be much tighter, and I'm just giving this as an example. And you can see, I mean, basically, if you were pegged to the SDR, if Saudi Arabia was pegged to the SDR instead of the dollar, you wouldn't gain much in terms of a tighter monetary policy because these things will go very closely together. If you were pegged to the SDR, now here's where an interesting idea has come up is that looking ahead, if you think, I keep clicking the wrong part. Looking ahead, if external surpluses continue and inflation is not temporary, inflation persists in these countries, the GCC countries will have to consider an alternative arrangement. If floating is not an option, then a basket peg would be the next best thing. And it would be a bridge to longer-term flexibility. The interesting twist here is that when you talk about a basket peg in the Gulf and in the Gulf region, both right now for the individual countries and for the single currency when it comes into being, the argument is usually made that you should peg to a basket. I think there's a lot of merit to that argument, pegging to a basket. What is an optimal basket for these countries? And I would say, apart from simplicity, etc., a euro-dollar basket would be a very good thing because it would cover most transactions that they have, and it will allow them to do the hedging to manage financial risks. The thing is, of course, if for the single currency, that's okay. But to leading up to the single currency, the only caveat I would make is that all countries would really have to adopt the same basket now to be able to determine at what rate to enter into the monetary union. This is a big issue as to what rate they should enter. And that's the reason they, in fact, set their rates. If you like to think about it, in 2003, they decided on a sort of form of an ERM, except that the major country was itself pegged, and they all pegged to the Saudi Riyal. Thank you.
Thank you very much, Mohsin. It's great to have that perspective, and even without the inside data, we got some very important insights. We're now turning to someone who's a guest for us for the first time. That's Maria Celina Berardinelli Arraes. I hope I didn't do too much injustice to her name. She is the Deputy Governor of the Banco Central do Brasil for International Affairs after having a long distinguished career there. And she is most welcome to enlighten us on how the leading Latin American economy and Latin American economies in general are viewing the rise of the euro. Thank you very much for joining us today. Please.
Thank you. Good afternoon to all. I'm very pleased to be here and invited to give the regional perspective, Latin America and Brazilian, on the use of the euro as a global currency. Especially because under my responsibility in the central bank, it comes monetary integration, of course, with Latin America, but we are always studying what's happening in the euro area, how the euro came to, perhaps one day, 20 years from now or some, we will have a successful monetary union there also. My presentation will cover an overall view, Latin American perspective, Brazilian perspective, and some general considerations at the end. Well, the importance of the euro is well known to everybody, especially at the time of the day that we have already reviewed. But I just put it there so that we can compare some Latin American and Brazilian data on that. Of course, the success of the currency after 10 years since its launch is related to the central role of the euro in the global economy and trade. But for Latin America, the U.S. still holds the largest share of the region's international trade, especially if Mexico is concerned. So I'm sorry because I have not turned the page on. I was saying something that was not related to the slide there. First, the pegging. What happens to in Latin America? Most countries have pegged to US dollar or have floating exchange rate regimes. Different degrees of floating, but floating exchange rates. So for now and for the near future, we don't see any possibility of pegging to the euro there. So my presentation will be mostly related to financial and trade aspects and reserve composition aspects also. So let's come to the Latin American. Among selecting Latin American countries, Brazil is the major commercial partner of the Eurozone. It's the greatest importer in relative terms and the second exporter to the Eurozone after Chile. But the US is still the Latin American major commercial partner, especially for Mexico. Well, the average of trade flows is about 13% of total Latin American countries considered. Excluding Mexico, however, the share goes up to 18%. In general, Eurozone import share is higher in the biggest economies. On the other side, export share to Euro countries is higher in the small economies. There's a wide room for improvement on trade relationships. Here we have the numbers. trade flow, Brazil is the 20th. In fact, for the Eurozone for Brazil is even more important than the United States. I don't have the data here, but as a whole, it's more important than the United States. Well, the magnitude of the euro used by Latin American countries as a store of value is not so clear. According to ECB data, developing countries have relatively more international reserves in euro than the global average. So, according to ECB data, developing countries have a share of 28%, 28.4%, and all in the totality of countries, 26.5%. These are the countries that have publicized data on reserve composition, and this is the composition for Chile, Peru, and Uruguay. Well, on average, the Latin American euro-denominated external debt is small, below 10%, and except for Chile, external assets and liabilities have similar euro participation. The current Brazilian policy follows basically the same pattern. Chile figures suggest a more active investment strategy for international reserves. These are the shares for total debt. But for bonded debt, there is a significant share of euro issues in total sovereign external bonds. Argentina and Mexico present the highest shares. I'm going to show the numbers. Brazil, 14% of the bonded debt denominated in euros. Argentina, 28.4%. Uruguay, 6.1%. Chile don't have information. Mexico, 18.4%, and Peru, 15.5%. Since, in general, we could say that central banks' share of reserves somehow mirror external debt or external liabilities. The numbers that we have shown here could give a hint of the composition of reserves of those countries. Now, the case for Brazil. In addition to being the most important partner, the Eurozone most important trade partner for Brazil, financial relations between Brazil and the Eurozone are very strong. Both commercial and financial relations seems to be more important than the relations with the euro currency. So this could be one of the main conclusions of the data showed here, of the analysis showed here, is that there's a room for improvement, at least for Brazil, there's a room for improvement for the euro currency, as even if we compare with the economic importance or the economic and trade relations and financial relations does not reflect exactly the use of the currency for Brazil. From 2001 to 2008, Eurozone countries originated an average of 21.5% of total external borrowing and about 48.5% of foreign direct inflow. That's the share of investment coming from Eurozone countries. You may see that is very high. Almost in 2004 is almost 60% and 40%. At least for foreign direct investments. In fact, a big chunk of this come from Spain. And this is the direct investment by Brazil in Euro countries, outflow from the country. From 2007 to 2008, direct investment by Brazil in Eurozone reached 7.7% of total direct investments by Brazil abroad. Of course, Latin America is the biggest partner alone, as a region. This is a view of the exchange rate, Brazilian exchange rate against the dollar and the euro. It for some time have decoupled from May 2005 to almost September 2007, and now it's almost varying together. Last July, the Brazilian government introduced a bill to Congress proposing the creation of a sovereign wealth fund. This is as have been mentioned, should and have to be considered in the analysis of currency use and currency composition of reserves, and sovereign funds should be brought to the analysis also. Our proposal has two main features, separated mainly funding by budget resources, not involving use of international reserve under central bank management, and possibility of investing on both external and domestic financial assets. But when it is approved by Congress and funded by budget and implemented, it will probably have different benchmarks from those used to manage international reserves. Could be more active in taking positions. Well, as I mentioned, the euro experience is an extremely successful one. It's a model in general for eventually monetary integration arrangements in the region. And the big question is, can the international role of the dollar become something different after the current international credit crisis? This issue has been raised here by a lot of presenters. Is this an opportunity for the euro? Well, if I may comment on that, I would say that it will much depend on how the economic and financial interrelations will emerge after the current crisis, and how are going to be the trade and financial relations after that, and what's going to happen to the dollar. So far, the dollar is more strong. So, and just to mention that we have, in Latin America, we have two specific regional payment systems. One is with whole Latin America and is denominated in dollars. That is the CCR that is mentioned there. And the other one was just inaugurated, just launched 2 weeks ago. It's only between Brazil and Argentina, and it's a main incentive to invoice the trade between those two countries, our two countries, in their own currencies. And of course, the euro is a very important fact for the Brazilian and other regional economies. It represents an alternative to further strengthen the overall trade and the investment flows. So, thank you very much.
When I did my homework for this conference, I collected some, I think if I count correctly, some 10 charts or so, which I think showed that the euro so far has had a rather happy childhood. But I think they don't matter anymore, so I decided to skip them. And I've resorted my slides a little bit. I hope that this sorting has worked. But I think what we are presently seeing is a big break, a structural break in the world financial system, and the way that the financial markets will look at the euro will be very, very importantly determined, I believe, in how the European Monetary Union's response to this present crisis evolves. And I would like to focus on 3 key areas that I believe will be of importance. The number one is the immediate crisis management. We have already heard this morning about interesting views, and I'll comment on this a little bit more. The second is the economic policy response to this crisis. And the third crucial point is, I think, the longer-term structural adjustment that needs to happen in the euro area in response to a world that I think is going to look very different once we are through this immediate crisis. Just to show you what the markets think about the euro, This is the daily chart that stops at the end of last week, because I was traveling in the course of this week. The market thinks actually the dollar is the safer asset in this environment. Just today, the S&P was down this afternoon 5%. The euro was down 2% to now 133. I don't think that it's entirely deserved, but it's clearly that the markets are beginning to questioning the effectiveness of the euro area's response to this crisis. I don't think it's entirely deserved, because I think that the European crisis management has not been so bad so far. And I think that was echoed in the earlier panel when Christian Noyer said that the Europeans had already done a lot, but it had come out in a piecemeal fashion, and it hasn't really fully appreciated. Over the last few weeks, we internally discussed what we would like to see as an effective crisis management plan. And I have to say we came pretty close to what Dominique Strauss-Kahn said this morning that he would like to see from the G7. We thought that to at least establish the conditions for overcoming this crisis, we would need to see a combination of public guarantees, of bank liabilities, a plan to recapitalize banks that look too thin on the ground, and thirdly, liquidity provisions, both from the central banks to the commercial banking system, but also from governments or government organizations into the markets. We have seen in Europe so far considerable progress towards this with the British plan, which has all these features, with some talk today in Germany that the Germans may come up with a similar approach to this crisis. And we have also, of course, seen in Spain the beginning of some measures to relieve banks of severely impaired assets. So overall, I think we're going in Europe, as far as crisis management is concerned, in the right direction, but it has come, as I said, unfortunately, relatively piecemeal, and I'm not sure actually whether we will make, here the Europeans will make much progress in convincing the Americans that this is exactly the way to go. So in the course of the day, I've become, after having started out very optimistic on the G7, joint G7 action, in the course of the day I've become a little bit less optimistic. But that was my first one, crisis management. So maybe this is not deserved that the euro is down 2% today. Next comes, how do we react to this financial crisis, because it's unavoidable, inevitable that it will have a severe economic fallout. Now, there was much praise for the ECB, deservedly so, to be on the spot with liquidity management. I thought, and I continue to think, that it was not a great idea to separate liquidity measures from interest rate policy, because this is really a broad-based crisis that begins in the financial markets and ends in the real economy. I was not very happy, not that anyone cared, that the ECB raised interest rates in July. I think that was barking up the wrong tree. The cat was not sitting on the inflation tree. I think it is sitting, hiding on the deflation tree. But this week has, me personally, for what it's worth, reconciled a little bit to the ECB. I think they're learning fast. Obviously, this chart is outdated. Rather than going up while the economy is sinking, they have reversed and go down. Against that background, I have to say, 1-1 now. This chart would have given 1-0 for the Fed, because I think that the Fed probably anticipated a bit earlier on the breadth and the depth of the problem, but the ECB is catching up. I regret a little that we had to see during this crisis between mid-07 and 08, a tightening of monetary conditions, which we estimate at the equivalent of about 150 basis points. That is unnecessary, but I think we're going to unwind this very fast. So monetary policy, I think, is also on its way. But that leaves me with an uneasy feeling that we absolutely need another ingredient, and here I'm getting now, unfortunately, a bit less optimistic, and that is fiscal policy. It seems to me that even if we succeed in crisis management, and even if we can stabilize the financial sector and the banks, we will not bring the banks by themselves to lend again. There is an enormous risk aversion, excessive risk aversion in the system, and in such a situation, the only credit-worthy in the eyes of the banks, the only credit-worthy borrower are governments. So there's a natural case for governments to step up to the plate, to supply to the market the securities that the market wants to see. This is not endangering the government's standing if in such a situation governments supply bonds. There is a shortage of risk-free securities. The markets will take them up willingly and prices will not go down when the government does that. And with the money the government can raise through this, it can support the economy. Now, some people who know me a little bit for a longer time, like Adam, will probably think that I have come a long way on that, but I think these are very special circumstances and one needs to think out of the box, and I'm a bit afraid at this point in time that the Europeans will have considerable difficulties thinking out of the box and hang on for too long to regimes that were set up for sunnier weather. And I'm referring here in particular to the Stability and Growth Pact. I think I've said to that point what I needed to say. Let me come to my last point. So I had macro policy, crisis management, macro policy response, but now I come to what I think is going to be crucial over the next years in order to make the euro a viable global, or keep the euro as a viable global currency. I think the big task over the next years will be internal relative adjustment in the euro area. So far, I think we have talked rather academically about the differences in competitiveness, the differences in inflation that is creating large external imbalances within the euro area. You see in this picture the development of unit labor costs in the course of EMU in different countries and the current account positions. I think the growth model on which the euro area has so far thrived, namely strongly real estate driven consumption in southern Europe, but also in some of the Western European countries, and I include here France, and in some of the Northern European euro area countries, for which I now take Ireland. This growth model is broken. These countries, in my view, will have to labor for a long time under the pressure of a weak real estate market that will depress construction growth, which has been a major contributor to economic growth in the past, depress construction growth, and keep consumption growth much, much lower than we've seen it over the last 10 years. These countries need to adjust by regaining competitiveness in a regime where they cannot have nominal exchange rate devaluations. So they need to engage in cost deflation. The Germans did this in the first years of EMU when they started with a cost disadvantage and a too high exchange rate. The others now have to learn this. They haven't done it before at all. And I think that once we are through this crisis, once we have digested the macroeconomic policy response, I think this is going to be a significant focus by the market whether this is indeed feasible. Because if it is not feasible, and some of you may think that I'm now fantasizing, but if it's not feasible, then I think the whole existence of the euro project is in danger. And I'm not saying this here just to make a cheap point, but I'm saying this because in the markets this issue is already being discussed and will continue to be discussed. Thank you very much.
Thank you, Tomas, for giving us something fresh to worry about. I'd like to invite, don't sit down, Thomas. I'd like to invite the panelists up here. We have the luxury of being back on schedule, so those who would, Randy, Maria, Mohsin, Thomas, George seems to have stepped out. We can open up for questions or comments on the floor, or if any of the panelists feel the urge to comment on what one of the other panelists said, I will let that be the first round. Thank you so much. Any panelists chomping at the bit to discuss other panelists? Or we have a mutual non-aggression pact? Okay, I'll leave it to aggression from the floor. Is there anyone who would like to ask a question or make a comment on this panel? Peter, a microphone is coming.
Peter Kennan, Princeton University. I'd like to ask a brief question of Mohsin Khan and then make a brief comment on something which Randy Henning said, taking my name in vain. Mohsin, would you feel free to tell us, in the privacy of this room, whether you believe that the monetary union of the Gulf states is actually likely to take place on or near schedule, whether the difficulties on questions of governance may be insurmountable, at least for the time being. Randy mentioned a proposal which Ellen Mead and I played with in the last chapter of our book on monetary unions, suggesting that the best candidate in Asia for a monetary union would be the ASEAN states. We said that partly for political reasons, that the Chinese were unlikely to join, the Japanese would not join if the Chinese did, and vice versa, and both, of course, have broader horizons. But when you look closely at the ASEAN countries, I think you have to conclude that Myanmar is probably not a candidate, that Laos and Cambodia are too underdeveloped compared to the others. Vietnam is somewhere in between. And Singapore probably would not join because of its present and unique status as an international financial center. That would leave us with a rather odd monetary union consisting of Malaysia, Thailand, Indonesia, and the Philippines, which is much less than ASEAN. Nevertheless, we suggested that that was perhaps the most likely if one asks whether you're going to have a monetary union of any kind in Asia. That seemed to us the most feasible and the most likely combination, but I would be willing to bet that it would be dollar-oriented and not euro-oriented. Thank you.
Thank you. Mohsin and Randy, do you want to say anything?
Basically, let me start. Yeah, sorry. The commitment to the monetary union, to the GCC monetary union, is being affirmed and reaffirmed several times. The most recently in September of this year at the GCC ministers meeting, ministers and governors of central banks meeting in Jeddah. And what they did in there was to recommend the establishment of a monetary council, which is the sort of the precursor to the Gulf Central Bank, equivalent to the European Monetary Institute. I mean, that's the idea. And that's going to be discussed by the heads of state in November of this year. That's by way of preamble. Every year they have said that they remain committed to the 2010 deadline, except this year. I mean, you can read whatever you want into the press communique, but they did not commit themselves to 2010. And I think the reason for that, I mean, Willem and Deutsche, etc., have their own reasons for why they are not going to have a monetary union. I think they are going to have a monetary union, but I think they're a long ways away in terms of the institutional structures that they need for a monetary union. There are two ways to look at it, Peter. One is that to say, you've got to have all these institutional structures in place. I mean, financial regulations ought to be consistent and so on and so forth across countries before you do it. The other way is to say to do it and they will become, they will conform. It's not clear right now, and I think that what I would say is that every year 2 years ago, the Saudi minister said that 2010 was challenging, and then last year he said increasingly challenging. This year he just smiled and left it at that. So that's really where we are.
Yeah, I fully take kind of on board what Peter has said. I think that it's obviously common currencies in East Asia, I think, face a lot of hurdles, kind of political and institutional and otherwise, and it'll be a while before we see any of them. I think the thrust of Peter's comments kind of reinforced what I had said about the region being more dollar-oriented than euro-oriented. I thought I'd take a second, though, to address some of the themes that Adam laid on our agenda this morning related to the attractiveness of currencies on the basis of security and foreign policy prowess. I think I'm attracted to this for two reasons. One, because I think we in this literature have probably tended to attribute everything that's unexplained in the gap between the fundamentals and the role of the dollar to networks and inertia, when maybe networks and inertia don't kind of explain all the residual, and there are other important things. I think it's completely plausible that the security and military factors would be important. And, of course, it resonates in the region writ large because of the U.S. role in the region. But I also have to say that if we look at the region country by country, it doesn't explain the cross-country variation in the role of the dollar and the pegging, because we see in the region that those countries that are closest to U.S. foreign policy are those countries that have the loosest tie to the dollar, and those countries that are more tightly tied to the dollar have more antipathy toward U.S. foreign policy. In the first category, we have Japan and Korea, which are the most flexible, and in the second category, we have China and Malaysia, which are probably not the U.S.'s closest friends in the region. So I think that there's a lot of it's a useful explanation, but it doesn't explain the cross-country variation.
I will not bother to defend myself. I'm just glad Randy bought himself more time by talking about my stuff. Next question, John Williamson, please.
John Williamson at the Peterson Institute. Well, I'm not going to defend you either, Mr. Chairman. I want to have another crack at Mohsin Khan and his suggestion that about his discussion of the pegging policies of the Middle Eastern countries, the Gulf countries in particular, and I really think it's a mistake. If one thinks that the purpose of a peg is simply to facilitate trade, then I agree that the dollar or the dollar and the euro, that's fine as a basket. But there's an extra factor that you didn't mention that really motivates the suggestion that the oil price be included as a component of the basket, not the total basket. That would be crazy, because then one would have had an enormous roller coaster in the prices of internal goods in these countries, but 10% odd weight for oil, and the purpose of that is to facilitate the adjustment process. these countries, they should save, and they are going to save a good part of any of their incremental oil receipts, but there is some part that they adjust to, and that adjustment is faster and it's more concentrated in the private sector if oil constitutes a part of the basket than if it's simply a dollar basket or a dollar-euro basket. Ideally, one might want them to float, and you say they can't float for institutional reasons. Well, we've heard that about a number of countries that subsequently did float, so I'm not absolutely convinced by that. But even assuming it's right, what one wants is surely a combination of a basket of dollars and euros and oil.
Thanks, John. Yeah, I mean, I was basically looking at sort of four extremes in my case. I was not looking at combinations in this presentation. That is, you know, pegging to the dollar, pegging to a basket, pegging to the price of oil, or floating. And no, you make a good point, and other people have made that too, of bringing oil into the picture, into developing an optimal basket. I think what the GCC countries and the GCC Secretariat and et cetera are going to have to do is, when they're working towards this idea of the single currency, that's one of the things they're going to have to confront, is what is the exchange rate regime they're going to follow. And all I said was it's most likely going to be a basket. If they don't, you know, if they move away from the peg, they'll peg to the dollar, they'll peg to a basket. I think I would. I take your point in that there are other reasons also that they're sort of comfortable with the peg. It's not just simply to facilitate. A lot of their financial assets are held in dollars. The main export commodity is priced in dollars. It just makes life much easier for them and simpler in that way. But at some point, if inflation continues, they're going to have to face up to it and see what they want to do. One thing, if I might mention, is Randy, just following up from Randy's point about the thing that I didn't mention in the other cases, that in the past year or so, there's been a lot of pressure, past year or two, a lot of pressure on the Gulf countries to either revalue or to go to a basket or to even float. And many people have made many good arguments, you know, as to why they should do one or not or the other. But I can tell you one thing, that the United States, the U.S. Treasury has done a remarkable turnaround. That 2 years ago they thought they should have more flexible exchange rate regimes. Last year on, they said peg to the dollar and do not move away from the dollar. That was the message that they were getting from here. So that just sort of fits with your thing about Adam's security sort of issue. All right.
This is a great panel. Next question, please, or comment. Yes, in the back. Please identify yourself at the microphone.
Hello, my name is Oliver Grimm. I'm a journalist with the Austrian newspaper Die Presse. I have a question to Mr. Randall Henning. You alluded to possible costs that the ascendancy to becoming a global currency might entail. Could you elaborate on these costs? Thank you.
Well, when I think of costs, I mean, I'm thinking of the costs in terms of monetary control, kind of associated with having large kind of outstanding kind of stocks of your currency being used abroad. The Bundesbank, the German Bundesbank, was attuned to this problem during the 1960s, 70s, and 80s, and actively discouraged the role of the Deutschmark abroad, largely for this reason, and reluctantly conceded that it had to be used more heavily within the European monetary system over time. But it was a reluctant concession, and they were concerned about monetary control primarily. I think the same potentially applies in this case.
I think we have time for one more, if there is one out there. Jean?
Yes, it's a question to György. you describe the way the countries that are likely to become at some point members of the EU have moved towards the euro. You haven't discussed so much what's happening to Russia, to Ukraine, which is in a more uncertain situation, and to some other countries in the region. So I would be interested in hearing your views on that.
Thank you, Jean, for this question. Indeed, I didn't spend much time, no time at all on Russia and Ukraine, but I have some data, but I'll skip through them. As far as the pegging relations is concerned, I did show that Russia has moved to a basket which now has also about a portion of the euro, while Ukraine is basically pegged to the US dollar. But what's interesting thing is that if you look at my table and what is the share of foreign exchange and the euro loans in the total loans of the households and corporates, in Ukraine, for the households, it's 65%. For the corporates, it's 41%. So the total is 50%. So it's very interesting that this is what happens in the Ukraine. However, in Russia, obviously, it's much lower, but still, for the total private sector, it's 20%. So clearly, obviously, Russia is looking at the pegging relationship, that it wants also to have something, not 100% pegged to the US dollar, wants euro in it. It's more interesting why Ukraine hasn't moved toward having more of a less pegged to the US dollar, even though the foreign exchange loans are so important. I have no real explanation right now to this, but I can tell you a story. I was in June in Ukraine, and I gave a speech at a university in Simferopol, and there were about 100 students and the professors. And they asked me to talk about the European integration and so forth. And at the end of my speech, I asked, how many of you would like to be a member of the European Union sometime? And I referred to de Gaulle, which said that he wants a Europe from Ural to Atlantic, and I explained that the Atlantic has already been reached, but before we reach the Ural, we need at least Ukraine in it. And surprisingly, 100% of the students put up their name, but none of the professors. Of course, I didn't ask the professors. I didn't expect them. So this is a very small sample, obviously, but it shows that belonging to the European Union how would I say, a desire, which seems to be a desire in Ukraine, but this will take some time before you get there. This is just a parenthesis, but now the other countries, I did say about the other countries in the Balkans, they're all very, very much either pegged to the euro or follow closely the euro, and the share of the euro in their loans and deposits are very high. And one thing that I didn't mention, but which is in the paper, is that the shipments to and from the non-euro area, but in the region of euro notes is very large. It was 37%. And interestingly enough, one reason that people say that this is very high, because some of the euro bills, euro notes, sorry, are higher than in the US. You have 200 and you have 500. So the black economy is using that as it's easier to use for the black economy that wants to pay cash, the large denominations. Thank you.
We're going to bring this panel to a close and let all of you hardy souls take a brief break before our all-star closing panel. I would encourage you after the break to move forward in your seats and enjoy the spacious tables. I just want to make one observation before thanking the members of this panel, and it's nothing to do with security. It's that we've moved from a world where talking about the euro was often discussed in terms of how monetary union would lead to real effects. And we spoke very heavily in Asia as well, in Latin America as well, about currency unions leading to explosions of trade, currency unions leading to greater cross-border investment, and so forth. And to me, one of the interesting commonalities, actually of all 5 presentations, was that most of them were putting the trade real side integration cart ahead of the monetary horse. So when Maria was talking, if you forgive me, the Deputy Governor was talking at the end, she talked about the initiatives of Mercosur and Brazil with the EU. Randy was speaking about the real side connections that already existed. Mohsin was talking about the trade links and using that as a way. And we've always known it's a two-way street. I don't want to pretend that it's different. But then when you take it to even the extreme of what Tomas was saying about the real adjustments going forward in the within the Eurozone as being a major factor in how the market perceives it, I think it's an interesting change in emphasis. And that may remind us that part of what's going to come out of the current crisis is possibly some changes in trade and investment flows, and that may actually be the lasting legacy rather than solely the financial. Just a thought from what I thought was an excellent panel, and I'm grateful to all of you for participating. Thank you.